Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, August 28th, 2015. In this video today, I wanted to go over some of the global currencies, really the big three, the US dollar, the euro, and the Japanese yen. Take a look at those. And for those of you who really don't care to trade currencies or really follow those, I will wrap this video up touching on some commodities, because the U.S. dollar has a direct, nearly perfect correlation with a lot of commodities, particularly oil, and there's some pretty compelling charts I'll share here at the end on commodities. So let's just take a look at the currencies real quick and see if we can determine where the dollar is going. Now, we're starting out looking at the euro-US dollar pair. This is a chart I posted just a couple weeks ago. We had prices within this symmetrical triangle, and at the time I stated if we got a breakout that we would see a move up to at least the 115 area, and that's exactly what happened. If you look at the crosshairs here, you can see that day it peaked here on Monday. It closed at 115.4, so $1.15 and 4/10 of a cent. So, or at least that's the ratio, I should say. Anyways, close enough for government work. That was my first target, which was the top of this zone here. So my point to that isn't to just harp on that call. It's more so that I expected, as that was resistance, I didn't provide additional targets, and I said at least a move there. So that was a very obvious target. This is a very large pattern. So my point is this: a pullback was expected. I'm a little surprised at the strength of the pullback, but I did add this horizontal line since that last chart, and as you can see, the dollar closed there. The pair, I'm sorry, the euro. US dollar currency pair closed there. That support level, you can see numerous reactions if you follow it to the left on the chart from above and below. I think it's a very valid support level, and so this is where I would expect, or I'm doing this video after the market close on Friday, and this is where I would expect maybe a reversal next week and a continuation or a resumption of the uptrend in the dollar, once again, just based on the size of this pattern. Technical analysis, if you want to try to get an idea of how high or far prices might go on a symmetrical triangle pattern, a simple measurement is just to take the distance to the widest part of the pattern and then add that to the breakout, or in some cases you can do it down here. But either way, we're going, the dollar has the potential to go a lot lower against the euro. Remember, this is the euro versus US dollar, so this is euro up, which is dollar down. And that's that. Let's take a look at the weekly. Enough on the daily. Weekly time frame. What we're looking at here, I've adjusted these arrows. I should put this one over here and this one down here. What happened is, in the past, this is an old chart and I didn't update it before today. I've showed these arrows before where these weekly oversold readings on the RSI in just about every case, or at least every case on this chart going all the way back to 2008, has resulted in a trend change, a bottom. So bottoms came when the weekly RSI became oversold. This one instance here was a failed signal. So right here we didn't have, there was a little bounce if you follow the vertical line up on the crosshairs, but oversold, we actually stayed oversold. So this is just a continuation. If you look here, the RSI barely crossed back above the 30 level, and only briefly, never made it back to the mid-range. Typically, once you become oversold, if you look at the past, you see a move back up to at least the midpoint range on the RSI, if not all the way to the upper end of the range, which is usually 70 is considered overbought. And so we finally did get that oversold. These persistently oversold readings, I should say, ended around this point, and that's when the euro-US dollar pair bottomed. And now what we're looking at here, this is a nice key resistance level, that same 115-ish area, and so this looks like a nice base. Now, so if and when the euro can punch up above that level, it is likely it will climb. These are some targets that I've added from before. I haven't updated this chart, but again, I'm expecting over time a much larger move. All right, let's take a look at At the yen. Okay, so we're looking at the U.S. dollar versus the Japanese yen. Now this way, you have the U.S. dollar first, so this is the dollar against the yen, meaning when this chart's moving up, the dollar is climbing against the Japanese yen. And just to clarify, when I say the big three, what I'm really trying to get to here is where the dollar is going. So I can look at the dollar index, which we will do next. Of course, that's really what you want to look at. That's an index against all the major currencies. But it's important to note that the euro represents 57.6% weighting in the U.S. dollar index. So over half of the U.S. dollar index is based on the dollar versus the euro. And then you have the yen coming in at a pretty distant second, but still notable at 13.6. So again, the euro makes up 57.6% of the U.S. dollar index, and the yen, the other 13.6. Again, those are those currencies against the dollar. So you really have to keep an eye on these two to see where the U.S. dollar is going. And I started out here on a weekly time frame. This was pointed out on the site way back in 2012. We had a breakout here, a back test. This was a nice, beautiful downtrend line. Great pattern. This is technical analysis at work here. Breakout, back test, and it took a while. It was a couple months of back testing, but then it finally took off. And as we all know, the yen has been falling against the dollar, or the dollar rising against the yen since. These yellow lines are just what I call minor uptrend lines within the larger pattern. So the larger pattern here is defined on the upper bounds by this white trend line, and the lower boundary by this white trend line here. So this is our uptrend line right here, our primary uptrend line. And as what happened with so many individual stocks and sectors, I'm going to talk about that. I plan to do another update on the broad markets, a bigger picture. We had a lot of stick saves last week and on Monday, or really this week. And we're looking again here at a weekly chart. So it's all that matters is what the candlestick, how it closes on a weekend closing basis. So as I said, this is Friday after the market close. And as you can see, we broke down intra-week, but we managed, this pair managed to snap back up inside the pattern. Now this is a pretty aging, or it's extended, trend here. The wedge is contracting, and I have these yellow lines. This is a pattern within the larger pattern, which is looks like an ascending price channel. The two parallel yellow lines. Also note here, let's brighten this up a little. The 40-week exponential moving average, which is the same as a 200-day moving average, has just done a phenomenal job since that. Really since the lows here back in 2012. Once we got above that, this is the back test, the breakout. As you can see here, that moving average pair has just followed the U.S. dollar Japanese yen pair up. Acted as support here when it was experiencing some weakness and sideways consolidation, and it comes in right now with that uptrend line, which comes in right under this sub-channel, if you will, that's within the larger pattern. So what happens here, if we do get in the coming weeks, as I expect, we get a breakdown below this level, then we're seeing three key support levels going. We're seeing this ascending price channel, which has been pretty well defined, especially on the downside. Numerous tags that will have broken down. The 40-week EMA will have gone, as well as this primary uptrend line that has defined this move since the lows. Now, as always, do you expect a trend line to break just because it's been going on for a long time? No. It's the divergences that signal a trend change is likely. So throughout greater part of this rise in the U.S. dollar against the yen, we've seen negative divergence forming, and pretty steeply here. So this line here, I could have colored that yellow. That really should match this ascending price channel here. So you have prices pushing up, making a higher high, and the RSI, the PPO, making lower highs, which is negative divergence, and that warns of a likely impending trend change in the very near future. So that's why I'm expecting the breakdown. It's hard to say whether that breakdown comes next week, comes in a few weeks, but as I said, based on what we're looking at on the daily chart, it is likely to come sooner than later, in my opinion. This is the daily chart, daily time frame of the US dollar yen pair. So we have here what we have. It looks like pretty much a double top high on the yen and against the dollar, or the dollar versus the yen. And I haven't drawn it out here. It's not true divergence because we had a slightly higher high at this point than over here. You want equal or higher highs over on this side, but close enough. I mean, that is, we're talking really just mere basis points. So that's essentially a flat, double top high. So we could say, in effect, the whole net effect is, bottom line, these are momentum indicators, and that's how and why divergence works. It just shows that the momentum is waning. We had divergence at this point. It didn't pan out for a correction, but it did pan out for, a sideways trend that went on for months in the pair. So most importantly, whether or not these divergences play out will have a lot to do with how much higher prices go. Right now, if you look at this line here, call it 122 on the pair. That is a very, very nice resistance level, and that's defined by it held, was tested several times from above here, had a very brief breakdown, lasted about a day or two, and prices shot right back up. And there was also the reaction high back here. It looks like March of 2015, as well as the reaction high right here. It looks like I guess that's late November 2014. So numerous reactions off that level, and this correlates with that daily chart on the euro dollar pair that I just showed when we started this video, how we pulled back to a nice support level there. And remember, that one's in reverse. That's a euro pulling back to support against the dollar. So I expect the euro to bounce, dollar down, and in this point, I expect the dollar down against the yen. And now let's take a look at the dollar index. Okay, this is the US dollar index. So this is the dollar against the other basket of currencies, which are the euro, yen, pound sterling, Canadian dollar, Swedish krona, and the Swiss franc. So we're looking at the dollar versus all the other currencies out there, and this is what we need to know where the dollar is going to go. As I said, looking at it against the euro and the yen, give us a heads up, help confirm or refute, any analysis that I have on the dollar, and in this case, it is confirming a reversal is likely. Let's take a look here. I already have these circled on the charts. These are this chart goes back. We're going back a decade here, and what we're noticing is there have only been 3 instances in the last decade, 3 instances where the US dollar index has been oversold, has crossed above the 70 level here. In fact, I could actually add some levels. We came really close. We're, give or take, just under that 70 level there. So if we want to go ahead and add those just to kind of illustrate what happens when it's been oversold. We had oversold or close to it. Again, these I didn't put the blue lines because we're just underneath, but you can see we were close. Either way, here's what happened. It's pretty apparent. The largest moves down. These were, technically bear markets in the dollar index because this is a long-term chart, on the dollar index. So these were bull and bear markets within. And those 2 major tops that we had so far came on the only times in the last decade that the RSI has come above the 70 level and stayed overbought, I should say, for any period of time. And now do we not only have overbought, we have a very extended. We crossed above the overbought level, the 70 line here, and we have remained, or we did remain, I should say, overbought all the way up until this point. So as you can see, the dollar already topped back here. So we've now moved down off that level, and just based on history and looking at this alone, I see no reason why we shouldn't have a comparable move down. And as you can see, those other 2 extremely overbought readings resulted in near 100% retracements. In this case, it was more than 100% retracement of the previous move. I'm talking this move here. You can see we gave back all those gains and then some, and on that run up there, we gave back most, but not all the gains. So I see no reason that the dollar index won't come down. Ultimately, I would say maybe to backtest this long-term secular downtrend line here at the very least, and that would be a considerable drop in the dollar. And as I pointed out here, these were almost oversold readings. I'm sorry, overbought. And you can see they still, each of those did result in sizable corrections. So bottom line, to be bullish on the dollar at this point, you have to just sweep fundamentals aside. And let me also say this. I truly see fundamentals. I factor those into my trading, especially longer term investing. But everything you're hearing about how much better financial or fiscal condition the U.S. is in other countries, that's been factored in. That's what happened back here. The markets always anticipate 6 to 9 months in advance. So again, if you're saying, well, there's no way the dollar is going to go down, we're in much better shape than the rest of the world. Again, you were right, last year, for the last year and a half, 2 years. So that's my take on the dollar. Okay, now we're just going to zoom down to a daily time frame here on the dollar index. We were looking at a minute ago a 10-year weekly chart. Weekly charts, especially looking at, as I was putting a lot of emphasis on those overbought readings, overbought, as I often say, can stay overbought, especially when you're on a weekly time frame. That you're talking a signal that can stay overbought for weeks or even months. So what you do, the weekly chart confirms my bearish case. Then I zoom on down to the daily time frame to really time the entries. Because as an investor, sure, you can position early. You can start building a position over weeks or even months, and that's what a lot of institutional investors do. But when you're trading, you need to be more specific on your entries. So taking a look at the daily chart here, keeping in mind with what I said on the euro and the yen daily charts a minute ago, what we're looking at on the dollar index, a very nice uptrend line here, this blue uptrend line, numerous reactions, a symmetrical triangle pattern as well. If you take the downtrend line off the highs, there's a few nice clean 3 reactions there. So we have this nice symmetrical triangle pattern, of which the dollar recently broke down from. So we had this move down, a big gap below it, which helps to validate. I often talk about breakouts and breakdowns of patterns, breakouts to the up and down side. The more impulsive they are, that only helps to further validates that trend line is a well-watched trend line, that it is technically significant. So, you don't see many gaps like that. And we had that huge gap down there out of the pattern, sharp move down, and we hit support. It's plain and simple. There was a reaction low right here. That support back from here. There was this bull flag continuation pattern back in early 2015, and that acted as support. So we've had one heck of a bounce, but now we're back to both that gap resistance. We're backfilling. We just backfilled that gap, and we're just shy of backtesting. So maybe the dollar could push up for another week or two. Maybe backtest at a little bit higher level, say over here. But ultimately, I would favor a move down. And the next time that level gets visited, maybe we get one other minor reaction, maybe not. But ultimately, I would expect more downside. Okay, now we'll move over to commodities. I spent what hopefully will be the bulk of this video on the dollar, and I spent so much time on it because of the importance, which I'll get to here in a second. This is USO, the crude oil ETF. As most of you are probably aware, we've just had an explosive move on here. We had this, strong divergence. In fact, just a couple weeks ago, I put USO on as an unofficial trade idea with a break over this uptrend line. We had broken above this yellow uptrend line, went lower, failed to make it through the that primary downtrend line that I had, and went quite a bit lower, and then we just took it out the other day. So I just closed out some puts today because these were those same calls on USO. They were real cheap back here, and this was one of the targets. I had all these target levels up, and at this point, got a little ahead of itself. But I did want to point out those divergences that I mentioned before. They remained in place, even though we hit a lower low. We went quite a bit lower than I had first pointed this out. We still had bullish divergence on the chart. And again, just looking at this daily chart, it would appear to me that crude is going higher. Now this chart gets interesting here. Let me pull up a chart of the dollar against oil. Okay, this chart speaks volumes to me. What I did here is overlaid the chart of USO. This is again, we're looking at a 2-year daily chart. I just took away the trend lines that I had there, and overlaid it with UDN. UDN is simply the US dollar inverse fund, so it moves inverse to the dollar. I'll show you here. Chart properties, comparison overlays. So we look at let's see here. Would have to put in on UUP. UUP is a dollar up. Do that real quick. Okay, so you can see UUP is a dollar up, UDN is a dollar down. So by doing this, what it shows, it's a little more clear. If we just overlay the dollar, some of you can make out the the inverse correlation, which is pretty clear there. But I think it works a little better since the flip it around. In other words, so this shows us, since we're looking at an inverse of the dollar, when the dollar goes up, which is down with this white line, oil drops. And the overlay, it's almost uncanny. All you hear about lately is oversupply. There's so much oil on the market. There's an oil glut. The shale producers and technology is making it cheaper to pull oil out of the ground. Well, this chart tells us that the largest part of the drop, by far and wide, of the price in oil has been the rise, a strong climb in the dollar. And again, if this chart doesn't speak volumes to you, then I don't know what to say. Now, what I wanted to point out here is, recently, we've had a very odd disconnect. We had that sharp move up in oil in the last couple days, while the dollar was actually rallying. Again, when the UDN is going down, the dollar is going up. And that's, I believe, will be a temporary disconnect. We all know that oil was just extremely oversold. So it was due, and had a high short interest, so it was due for a short squeeze, short covering rally, and that is one reason I decided to book profits on that position I had today. That was an off-book position; it wasn't an official trade. So again, now the bigger picture on this, forget about this little short-term disconnect. The bigger picture is, if my call on the dollar pans out and we're looking at a major trend reversal in the dollar in the coming months to possibly years, then you're going to see what I think can be just almost an outright explosion into the commodities. Because as I said earlier in a post today, as we all know, there's just a ton of liquidity sloshing around these markets from all the money printing the central banks have done. And let's say we do get that, a bear market in equities, and money starts pulling out of there. And as I mentioned today, bonds have nowhere to go. In a zero interest rate environment, for the most part, bonds have nowhere to go but down in price, meaning up in yields. So money's going to find a home. And as I said, commodities are on the tail, probably the tail end of a vicious bear market, one of the most vicious bear markets, that they've experienced. And that may be what we're seeing here. There may be a lot of those anticipating. The charts on commodities are really starting to firm up. Let's just take a look at a few, and then I'll wrap up. Okay, this is, I'll go through the ETFs of the commodities. For those of you who follow the site, on the live chart page you're probably familiar with, I do have links to several spot commodity prices via stock charts. And I may add some more, because I made a claim earlier in the year. In the beginning of the year, I stated that I expected, in 2015, I expected commodities to outperform equities. And although we're a good way, heading into the end of the year, about to head into the fourth quarter, I still believe that to hold true. And as we all saw, on Monday, and as I often state, stocks drop much faster than they fall. And in a correction or in a bear market, it isn't only unusual it would be to see this happen, but it would be unusual not to see this happen. The fact that stocks correct a lot faster than they rise, and in corrections and in bear markets, you see months and sometimes years of gains wiped out in just days, weeks, or months. Wiping out several years of gains in the stock market. So again, just take a look at any 20, 30-year chart on the stock market, and you'll see that to be true. And so, very possible that stocks can, be down from where they're trading right now another 15-20% by the end of the year, and commodities, although still underwater for the year, are certainly looking, set up for some nice rallies. And as I said, if that money that's floating around, it's going to need to find a home somewhere. And if it, my suspicion is, it's going to find its way into commodities. In fact, the charts are confirming. Here's wheat. What we had here: bullish falling wedge, breakout, back test, and a nice run up in it. A lot of these I pointed out when it happened. Some of these fell shy of my targets, but what happened? Prices came in, made a marginal new low. However, those divergences have only been extended. In other words, I had divergence drawn here at the time, and as you can see, we still have some strong bullish divergences in place right now, even larger divergence. And, the scope of a move, if we do get a bull run here, is typically relative to the, magnitude and duration of these divergences. So this is divergence that's almost, formed throughout the year since, going back to late January, when the MACD put in that lower low back here, and same with the RSI. So that's wheat. Okay, I won't go over them all. We'll just look. There's corn. Same story we had here. There was a divergent low right there. This was pointed out at the time. That was actually a trade idea on the site, and I'm talking about these lines versus this steep bullish falling wedge, sharp breakout. But since then, like most other commodities, prices kind of drifted back down lower. Now, this was due to dollar strength, in my opinion, largely due to dollar strength, more so than demand. I know the headlines sometimes will tell you otherwise, but you can plot any one of these commodities against the dollar, and you'll see similar, a similar relationship to that I just showed with oil. So there's corn. Again, it drifted down in this falling wedge pattern, had a nice breakout, ran up to that level again, and it's back testing. This is a downtrend line, so prices have, it's the price action has been a little sloppy lately. Of course, that is a function of the volatility we've seen in the market, this trading action right here over the last week. But strong divergences in place, and like many other commodities, soft and hard. That one looks good. There's coffee, symbol JO. And, I had this trade on a breakout here. That breakout went up, fell just shy of my first target, even came down here, didn't find support on that gap support. But what it has done, it's essentially back tested that wedge at a lower level. So, personally, I'll probably start. I do have some commodity positions now, and I'll probably start aggressively scaling into some more and have these as trade ideas on the site on Monday. But by all means, these are the charts, so feel free to, if you see something you like, go ahead. And if you have a question about targets or stops, I will probably revise these targets. But as I said, with so many of these, you can see the divergences have only grown larger and were not negated or wiped out on that move lower. So if I was bullish on coffee back then, I'm even more bullish right now. Okay, so I hit on just a couple of the commodities that you can purchase through ETFs or trade futures. And this is the Bloomberg Commodity Index. This is probably the most representative commodity index out there. You can buy the DBC, which tracks the, I'm drawing a blank on it, but the DBC, which is another commodity index, it's nearly half oil, if I'm not mistaken. So that one's a little skewed. Not that I'm not bullish on oil, definitely for the long term, but this one, I believe, is a little more diversified. So just taking a look at the commodity arena, what we see here, and we are looking at a chart that goes back. So long-term weekly chart, let's see. Okay, 10 years. It's a 10-year chart. So we're looking at a decade of price history on the Bloomberg Commodity Index, and what we can see here, currently we have this nice falling wedge / descending channel pattern. Oops, didn't mean to do that. Let's try to screen draw here. A couple things I wanted to point out. Here we go. In the past decade, we've only seen this commodity index become oversold once before. This is a We have two clusters of oversold readings here, but that actually, I actually prefer to see this than I do this, because this shows us nice positive divergence. So what we have here is this bullish falling wedge pattern, or slightly contracting channel, if you will, and we have the potential here. If commodities can put in a reversal here soon, this PPO is going to turn back up, confirming that divergence. We already have the divergence in place on the RSI, and again, the only other time we've seen anything similar to this as far as being so oversold was back here, in 2009. And those oversold conditions from there resulted in a nice bull market in commodities, which ended in 2011. So oversold, bullish divergences in place. There's a trend line to watch, but my first target, we're around $89 right now on the Bloomberg Commodity Index, and that target alone would take us up to about 105. So that's a little better than 15%. And my guess is over time we'll get by there, because if I were only looking for a counter trend rally in an overall secular bear market in commodities, and we broke this trend line, then that would be my sole target. But in this case, we'd probably get a reaction there, meaning a pause or pullback, but ultimately move higher. And again, first things first, there's some work to be done. We need to see confirmation of that reversal on the dollar that I'm looking for. And of course, we need to see the divergences on these charts play out. But I think, again, commodities looking forward, going out into year end, and especially 2016, I think will be the year of commodities. So this has been Randy Finney with Right Side of the Chart. I hope you enjoyed.